Welcome to the deep dive. Today, we're looking at some really specific tips you sent over. They're all about timing trades, buying and selling options, calls, and puts.
Right. And the goal, as you put it, is trying to figure out how to potentially get better prices, better premiums based on when you enter the trade.
Exactly. It's a focused set of ideas. So let's just jump right in.
Sounds good. What's interesting right off the bat is how they all tie into market moves around key technical levels, resistance and support.
Yeah, that's the core. Okay, first tip. Selling call options. It says wait for a market rally, then sell near a major resistance level. Walk us through the why there.
Sure. So the thinking is after the market's gone up rallied, there's often, more optimism. As the price gets close to a resistance point, a level where it's historically struggled to push higher.
Uh-huh. Like a ceiling.
Exactly, like a ceiling. Call option premiums often get a bit inflated then. People are maybe anticipating a breakout. So if you sell a call then, you collect that potentially higher premium.
And you're betting it won't break through that ceiling, so the option expires worthless for the buyer.
That's the hope, yeah.
Yeah.
You capture that richer premium driven by the rally hitting resistance.
Okay, that makes sense. So what about the next one, selling put options? The tip here is wait for a market fall, then sell near a major support level.
Right, it's pretty much the mirror image. A support level is kind of like a floor where prices have tended to stop falling and maybe bounce.
Okay.
So after the market drops down towards that floor, fear tends to increase, right? People worry it might fall further.
Yeah, you see that sentiment shift.
And that fear bumps up the premiums on put options.
Mhm.
So if you sell a put near that support level, you're collecting what might be an inflated premium.
And again, you're betting the floor holds. The price stays above the support level.
Precisely. You sell when the premiums is potentially higher due to that recent drop in proximity to support.
Got it. So for selling, you're sort of leaning against the recent move near these key levels, trying to collect a higher premium.
That's a good way to put it, yeah. Now, buying is a bit different.
Okay, let's talk buying. Third tip, buying put options. It says wait for a market rally, then buy near major resistance. This sounds a little backward. Buying puts after prices went up.
It does seem counterintuitive at first glance. But think about it. After a rally pushes prices up towards resistance, what happens to put option premiums?
Well, if calls got more expensive, maybe puts cheaper.
Potentially, yes. The immediate fear of a down move might have eased off a bit during the rally, so put premiums could decrease temporarily.
Ah, okay.
So if your analysis actually suggests, hey, this rally is likely going to fail at this resistance level and we're probably heading down soon,
Mhm.
then buying a put near that resistance when its premium might be lower.
Could be a cheaper entry point for a bet on the price falling. Okay, I see the logic now. You're anticipating the reversal.
Exactly. You're looking for that potential dip in the put premium right before a potential drop.
Interesting. Okay, last one. Buying call options. The tip is wait for a market fall, then buy near a major support level.
And this follows the same kind of logic as buying the puts, just flipped. After a market fall towards support, fear is up, right?
Right, so put premiums might be higher.
Correct. And consequently, call option premiums, the ones betting on a price increase, might have gotten cheaper during that sell-off.
Because fewer people are expecting an immediate bounce, perhaps.
Maybe, or just the general sentiment is down. So if you think, okay, we've hit this support level, it looks like it might hold, and we could bounce back up, then buying a call option near that support.
When the premium is potentially depressed, could be a good entry point to play for that bounce.
Exactly. You're trying to buy the call when it's potentially on sale right before a possible upward move from support.
So it really comes down to these key levels, doesn't it? Resistance, that ceiling, and support, the floor. And how market moves towards them can affect the option prices.
That's the essence of all four tips. Using those expected fluctuations in premium around resistance and support levels, whether you're buying or selling. It's all about trying to time your entry based on those dynamics.
And remembering, of course, these levels aren't guaranteed brick walls, they're just areas of interest.
Absolutely critical point. They are probabilities, not certainties. And volatility plays a huge role too, which we haven't even dived into, but it impacts premiums significantly around these points.
Okay, so quick recap for you, the listener. Sell calls after a rally near resistance. Sell puts after a fall near support. Buy puts after a rally near resistance, looking for cheaper premium. And buy calls after a fall near support, also looking for cheaper premium.
That sums it up nicely. It's a strategy focused purely on entry timing relative to recent price action and technical levels.
Right. So thinking about this, it really highlights the importance of those levels themselves.
It really does. Which leads to a good thought to leave you with. Given these timing ideas rely so heavily on resistance and support, what further research could you do on actually identifying reliable resistance and support levels for the specific stocks or assets you're interested in?
Yeah. Because finding those levels accurately is key to even trying these strategies. Lots of ways to approach that, I suppose.
Definitely. Technical analysis tools, chart patterns, volume analysis, exploring those could be a really valuable next step if these timing ideas resonate with you.